Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Welcome, everyone. This is the next edition of On the Edge. How real estate deals, commercial real estate deals actually get done. Today, I'm going to welcome a great friend over the last, decade plus, Mr. Daniel Cho with Range Summit. Daniel, welcome to On the Edge.
Thank you, Malcolm. Thanks for having me on.
So, many years ago, Daniel and I figured out somehow we were walking into a bar or somewhere and some idea came out, and we realized that not only did we have the same birthday, we have the same birth date. We were both born in the exact same year and the exact same time. So welcome to On the Edge as my birthday friend.
Yeah, it's the big 5-0 this year, right, Malcolm?
We're hitting it, man. You're giving it away. I feel like we're like middle Gen Xers here hitting our stride. Well, Daniel, tell everybody a little bit about yourself and about Range Summit. We'll get into kind of the platform and the things that you're investing in, but where do you currently live and work, and then kind of how did you get into the business?
Sure. So I am based in Denver. Our company is called, as Malcolm mentioned, Range Capital. I came to Denver, 20 years ago. It was really more of a lifestyle change. I did go to University of Denver, DU, for a year to get like the master's in real estate degree, and loved the city. I was married at the time. I'm still married, but was married, and so we really wanted to make Denver our home. Obviously, a big part of business school is not just learning, the basic skills you need, but developing a lot of relationships. And I think relationships is really what carries our entire business. So I started working for a real estate sponsor in 2007. So just perfect timing. He was very successful. He's our age, young like us. At the time. And when 2008 hit, it just all blew up. And through no fault of his own, it was just a very tough time. I learned a lot about modeling and about also, recessions. And I kind of decided I wanted to go to the finance side of things and not be on the sponsorship side. And no criticisms about people who choose to go on the sponsorship side, but I just didn't have the stomach for that kind of risk. What I saw in 2008 was really tough.
Yeah.
So I didn't work for a year or so, but I landed at that time, a very small firm. They focused on equity finance. So it was an LP investment firm, and just kind of learned the ropes there. I was their managing director for 7 years. I pretty much did 95% of their deals.
Yeah.
And and as it usually occurs when it's time to go out on your own, found some great partners in LA, guys that I had done deals with before, and we started Range Capital in 2017.
That's a great story. And so maybe if we could unpack that a bit. So you've been involved in what I like to call the middle market LP equity investment game for now north of, I call it 15 years. And that's a really interesting place to be because, as we all know, that's probably the most fragmented and has the most opportunity, but also has the least amount of available capital. Generally speaking, you kind of live in a world where you're above the syndications, but you're below the large scale institutional LPs that are out there. How did you get into that world, and kind of what are the things the audience might want to learn about how kind of differentiated Range Capital is as it relates to that?
Yeah, I mean, there's a lot to unpack there. So, to be honest, starting in 2009, I would have taken any job in finance. And like I said, I just happened to land at a firm that focused specifically on those middle market kind of assets. So larger than syndications, but sub-institutional. And what I really learned about that asset class, what I like about that asset class is it is fragmented. That type of real estate is just generally owned by guys. They're not owned by big real estate companies. And when you have ownership like that, their opportunities arise because of just totally external factors, right? Like guys do estate planning and tax planning, divorce, partnership dissolution, just other types of issues that institutional or corporate owners of real estate, they don't get divorces, they don't have to worry about estate planning and their heirs
Mhm.
and things like that. So I wouldn't, I just sort of, that's where I started my career, but I definitely very early on recognized the benefits. And as you noted, right, there's not a lot of available capital that plays in those kind of very small ticket sizes, like bigger than syndications. And the reason is because it doesn't generate enough fee income for a lot of
Right.
investment companies to sustain themselves. So you've got to really thread the needle, because if you want to go institutional, which my prior firm did, and no criticism, that's just the way they wanted to do. They went from 30 to 150 to 500 to a lot larger, and then they got bought by a much larger company. If you want to go on that, use that model, then you've got to build up a big office, a big back office, especially asset management, compliance, legal, treasury, things like that. And you got to feed that machine, and that's a tough thing to do, right? If you sort of don't manage your growth. I really like where we're at, which is, we keep our team small. We raise small funds. But again, you got to raise enough to keep the lights on, and to keep the operation going. And you're definitely threading the needle, because you can't be so small that you can't pay your people and keep the lights on.
Yeah, no, that's it's interesting. It's but there's such an opportunity, such a vast, I think if you look at the stats, in this, and we'll get into kind of what the sizing elements mean here, but this
Right.
middle market and even lower middle market, really has these really interesting opportunities where you can get kind of outsized yield, much more opportunistic, opportunities where you're acquiring where, there's maybe not as much competition, but you really got to get in there to understand ultimately who your exit buyer might be in that space. So
Yeah.
maybe chat
Absolutely.
about, kind of the size. Well, let's get into the particulars and sizes, right? The smallest types of equity investments you'll make, and maybe even the largers. And we'll get into the asset classes, but I think just for the audience to understand that.
Yeah, so we always say we write $2 to $10 million tickets. So $2 to $10 million of equity, LP equity into a deal. You're talking about deals that range between, let's say, 5 and maybe 30 million of total value. Which, once you get to 30 million, you do start to bump up against institutional buyers. But that's pretty much the size range. I mean, our perfect deal size is 4 to 5 million, and our perfect fund size is, let's call it 60 to 80 million. So do the math. That's maybe 10 to 15, 10 to 16 deals in a fund. We do recycle some of the capital in our fund. So maybe you get a little bit more. Our fund 3 vehicle was 60 million in commitments, and we invested 80 million. We made 80 million of investments. But yeah, our perfect size is really, call it $5 million.
Yeah, and by the way, that's just really is a sweet spot for where the gap is in the market. There's no question
Yeah.
about that. And like you are incredibly thoughtful about how you look at the deals that you're underwriting and the deals you do get involved in. But how does a sponsor, a GP, think about really impressing, Range and its prowess, and how do they become like a partner of yours? How do they become an operating partner of yours? How does that actually start for you guys?
Yeah, I mean, so it's tough. Like the first few deals that a sponsor does, like we don't bank like truly emerging managers, right? You have to have somewhat of a track record. So the
Yeah.
natural progression is, you're a guy, a couple guys, it's a closely held partnership. They country club a few deals, they have a couple round trips, but they start wanting to do larger deals where they, either they just can't pass the hat and fill up $6 million. So they go to Way Capital. Way Capital puts, them in touch with an LP group, something like that. But it is track record for sure a little bit. It is also just kind of a fit. It's a little bit of a cliche, but we always say, this is not a transaction based business. This is a relationship based business. And a lot of the sponsors I work with, longtime sponsors, we didn't do our first deal for a couple of years. Now we talk about deals for years and years and years. and they'd show me deals, and sometimes I'd say no, or sometimes our structures didn't work for them, so they'd say no. But it definitely takes a little bit of time. And I mean, this goes without saying, as an LP investor, you're investing in the sponsor. You're not really investing in the real estate. And, when you've done it as long as you and I have, Malcolm, the real estate's actually the easy part, right?
Yeah.
The modeling is actually the easy part. It's really making sure you have sponsors who are good operators and good people. And, I'll be honest with you, I've made a couple mistakes along the way, and, I've gotten tied up with people who just, they just weren't great at what they do, or they weren't great communicators, or, one of them was just really not even that honest of a person, right? It's
Right.
tough. So I certainly don't bat 1,000 on my sponsorship, my sponsor relationships. But yeah, it really is, it's a process. The sponsors that just barrel right in, and those tend to be, not to, paint it with too broad of a brush, but those tend to be the younger guys who just kind of barrel
Yeah.
in, and they just want to get the deal done. And they don't necessarily think about the relationships and the time that it takes. But I'll tell you this, Malcolm, once we find a good sponsor, I mean, I've got a sponsor, you and I both know who it is,
Yes.
but I've done 45 deals with them over the course of my career. Now that's a 10, 12-year career, so it's not like 45 deals in 1 year or 2 years.
Yeah.
But once you find that sponsor and that business plan that they do that you really like, man, you just ride that horse until you get off.
I mean, you said a lot there, and it's really interesting. I think in this business, you'll always hear me say, the debt markets are transactional in nature, although relationships are everything, right? But they're
Yeah.
transactional. Here's a deal. We're going to lend money on this particular deal and the like. But when it comes to equity, it's all about relationship and growing businesses together. And it really is a marriage.
Yeah.
It's dating and then it's a marriage. And that's why, generally speaking, you can't just step up and say, hey, I've got 30 days to close. Can you go find me an equity partner? That's generally challenging because you can't date and get married in a 30-day period of time. You certainly can't do it in real estate. And it's just one of those things where it does take, sometimes it may take 6 months, sometimes it may take 6 years. You just really never know. Not to get into that one particular relationship too much, but, generally speaking, what were and what are the things that have made that relationship grow so much? What I mean by that is, we always talk about, should you raise a fund? Should you go by deal, get into a programmatic relationship? Generally speaking, how does it grow with the way that you're looking at it? Besides, obviously a good strategy and the like, but why did that grow to 45 deals? It's incredible.
Yeah. So you can't overlook, you mentioned it, and you can't gloss over it. It's got to be a unique business plan. There's a lot of ways to make money in real estate, as you know, and there's a reason that everyone does value add multifamily and value add industrial. There's a lot, or not everyone. There's a reason that is the most prevalent business plan, and not just in the middle market, but also in the institutional markets. So that particular group did have an extremely unique business plan. I mean, we don't have the deal flow that I used to have when I was at the much larger shop, but we were literally looking at 12 to 1,500 deals a year. So that is like 4 to 5 inquiries a day we were getting. So, you see a lot of the same business plans. So when you see something unique, it definitely piques your interest. And then you sort of get into the people part of it. And that one, and it's a lot of our relationships. You go out there, you meet their team, you understand what their background is, you understand what their motivation is. And, they had an interesting motivation in that they were looking for a very particular type of equity structure. They were looking for partners, but they were looking for partners, to be blunt, that they could kind of get rid of because they were a family office. So
Yeah.
They had their long-term holders, as many family offices are. So, they want to hold long-term, but they need some equity to get them through acquire and stabilize and then sort of buy us out. So it was a great marriage of, business plan, personalities for sure. And then our equity was structured in a way that allowed them to achieve their goals, even though our goals were very different. Just, I'll mention, it's not a sales pitch, but Range's equity is very short-term equity. We like 3-year business plans or shorter. And again, it's not a criticism against people who invest for 5, 7, 10 years, but we just like to get in, get out. We're not so focused on cash flow. We're very IRR driven, and we like to recycle our capital. I mean, that's a great way to get your fund business going. But going back to your original question, it really was just a nice marriage. Another example, we do a lot of commercial condo conversions, and I've talked to you about this at length,
Yeah.
and even at your conference. There's a
Yeah.
lot of equity people who won't do it because the tax treatment is terrible, and you get your money back too quickly. And for us, we're like, hey, we love that. We don't mind paying taxes if we're making enough money, and we like to recycle our capital. So that type of structure works, and as a result, we're really, I don't know about number one. We don't track stats, but like we do as many commercial condo conversion investments as any group in the country. I certainly know that's true.
So actually talk about that because it's such a unique thing that you're doing there. And I don't want to get too into it, but what is attractive about it? It's just to getting in and getting out relatively quick. You're
Yeah.
obviously, you got a good expertise in that, but what's your thoughts as it relates to that particular strategy?
So what's really attractive about it from a risk standpoint is this. When most people, when they buy an apartment building or an industrial building, office building, it's either 100% sold or 100% unsold, right? I mean, the outcome is very binary. And so even you can do a great job, the CapEx and the lease up and the stabilization of an asset. But if the credit markets tank, your value is not there and it's very binary, right? It's just one transaction. But if you buy a project that has 20 condominiums, you get incremental buy downs of your risk. Your risk goes down incrementally every time you sell. And I'll give you a great example. We had a deal in San Marcos. It was more units than we liked. It was like maybe 40 units. We sold the first 35 units and made all our money back plus a nice profit, kind of almost 20% IRR. But we got stuck on those last 5 assets. And, the market slowed down. Things got a little bit choppy. And so what did we do? We just slashed the prices and sold those last 5. And we were already, like I said, we had already made our money back. We had already made a nice profit. And so those last 5, I was fine with, we slashed prices probably 40% on the condos and just sold them just like that and got out of the deal because we like to, again, get our money back quickly. And so it's just a really nice way to mitigate risk in a deal. Now, you can't do all condos in your fund. That's why you have a fund. You have to have a good mix of assets and business plans and markets and all that stuff. But we really like the risk profile of those condo kind of deals, commercial condo deals.
Sure. And by the way, was that San Marcos, Texas or San Marcos, California? I think it was Texas.
San Marcos, California.
Oh, California. There you go.
Yeah, your neck of the woods.
I'm glad to see you're investing in California.
Yeah.
Just generally speaking, one of the interesting things you mentioned there is you're allowing the sponsors to kind of have a longer term outlook, but yet allow you to exit out of the transaction. So let's talk about that a little bit structurally, because, in general, you're probably coming in some kind of LP, but maybe some type of pref or some type of like crystallization that allows them ability for the sponsor to exit your investment. How exactly are you doing that?
Yeah. So it's either a minimum multiple or some sort of IRR hurdle where, we're happy for them to buy us out of the investment and they can take all the upside after that. And, it's not a judgment, right? Or it's not right or wrong, but there's a lot of equity groups, a lot of investors who, they want to count other people's money. And if the deal makes a certain amount of profit, they want their, fair share of the profit. And there's certain situations and there's certain sponsors where that just doesn't work. But if you like the sponsor and you like the deal, we're happy to get out in a shorter term. And again, I go back to recycling. It works for us structurally because we recycle capital in our funds. It's not even that necessarily creative, but it is unique. There's a lot of LP investors who, they're like, hey, sell the deal and the deal makes $100. We chop up that $100. However you want. But we are a little unique in that we will take buyouts, again, only in certain situations, not all asset classes, not all business plans, but we'll take a buyout and be happy and move on.
I think it's super unique. Would you think that has allowed you to generate the ability to do a lot more deals and be selected?
Oh, yeah.
That's cool.
Yeah, for sure. I mean, So and within our fund, we're actually required to have different types of equity. So we have yield only pref equity, we have
Mm,
participating pref equity, and then we have common equity. Now, most of our investments are common or
sure.
JV equity. But yeah, those pref equity investments, when you find the right sponsor, they, they love it. They're just like, whoa, wait a minute. I can just pay you a certain multiple in a certain amount of time and you'll just leave and be happy. And yeah, it's
Kind of
definitely
like having
something
your
that
cake and
we
eating
love.
it too, as I like to explain that.
Yeah, yeah. And you can't worry about what those sponsors are making in the end because ultimately what's good for them is good for you because they're going to come back, they're going to become more successful, become better capitalized,
Yeah.
and then they're going to bring you more deals. And so that's the way we look at it.
I mean, I call that being a very pragmatic investor,
Yeah.
and that's definitely who you are. So, okay, generally speaking, the asset classes and geographies that you do invest in, and this is a good time to maybe chat about. Don't get into the esoteric things, I suppose, but just in general, what are the asset classes you are investing in, Daniel? And then also just geographically, how are you kind of looking at the country from an investment thesis?
Yeah, so we don't chase geographic markets. We are required actually within our fund documents, our fund parameters. We can't be over allocated in California, Texas, whatever the case may be, the Midwest. So we do have required, I guess, stratification of geographic markets. So, we don't really chase specific markets. I mean, I've got deals right now all across the country. The only state that really we have a real tough time in, and this is a more recent development, is Florida.
Hmm,
And that's really an insurance thing. That has nothing to
sure.
do with the sponsors or the real estate, but insurance in Florida is becoming a real issue. And so we tend to avoid that. Esoterically, I know you wanted to avoid that. Houston's also a tough market, but again, that's only because every single asset I've ever invested in Houston has flooded. And sometimes you just get tired of it, right? You just really,
Yeah.
it's hard. But aside from that, we invest all over the country. I mean, we like to stay in like top 50 or top 100 MSAs. So we tend to not invest in really small markets unless it's industrial.
Mhm.
Industrial is a very different sort of approach. And then you asked about geography. Oh, and asset classes. Again, the fund is required to have a broad diversity of asset classes. Of course, multifamily and industrial are our most prevalent asset classes just because it's just, there's a lot of sponsors that do that. But, we invest in land. I mentioned land. We're looking at an iOS deal. We have invested for sure in the past. We've invested in office. We've invested in retail. Let's see. We don't have, trying to think if we have any self-storage or hospitality on our books right now. I know you do a lot of hospitality,
Yeah.
Malcolm. We
Yeah.
don't have any on our books right now. But it's not to say that we wouldn't look at it. It's just we don't have any on it right now.
What is look, this is also, we've been in, you and I are obviously getting to I say latter, we're definitely middle age, I suppose, like we call it, right?
Yeah.
Where are we right now in the cycles and how you see it? I mean, we've been in this massive escalated interest rate environment for a number of years. How have you managed that with your operating partners? And then generally, where do we sit today and kind of where do you see us going, being a little bit of a prognosticator here?
Yeah, I mean, it's always tough to make predictions like that. We certainly feel like interest rates are going to go down, and everyone focuses a lot on the 10-year. I think, and I mentioned this at your conference,
Yeah.
the next year or two, there's going to be a lot of crosswinds
Yeah.
in the economy, and I think that's just a reflection of the current administration, and politics
Mhm.
has a lot to do with it here. But I think that the market is going to be choppy. I wouldn't say we're in like a cycle right now. We're just sort of, we're doing fine. I mean, the fundamentals of the economy are good, but you've got just a little bit of bumpiness and rockiness. Now, I'm not trying to pitch range, but what we stick to is that regardless of whether the cycle is going up or going down, when you're in the middle market, you always find opportunities. I mean,
Yeah.
I don't know, 2015, 2016, when I was at the last shop, I mean, that was the hottest economy.
Yes.
That was the end of the biggest real estate run up ever in history. And
Yes.
that's not even in dispute. Real estate valuations were sky high. Debt was cheap. And we were still finding good deals that, sort of penciled out to our, relatively high return requirements.
Yeah.
So we like to say that our business plan, because we're in the middle market, is kind of acyclical. But I don't know that I can say we're in a cycle right now. What we're in right now is we've just got a lot of crosswinds. We've got a lot of things that are helping us. We've got some things that are sort of hurting our opportunities. Obviously, I'd like to see the 10-year yield go down. I'd like to see borrowing costs go down. But yeah, we're still finding great opportunities.
I mean, it seems to me that you're investing in things that the underlying business plan is succeeding in regardless of the interest rate environment, meaning that you're acquiring assets, you're generating massive increase in NOI, and you're doing a lot of really value add strategies that are making these assets worth a lot more than what you're acquiring them for, which
Yeah. Yeah, and you mentioned NOI and income growth. That's obviously something that investors look at. But when you talk about land for housing and commercial condo sales, like those are not income type
no.
investments, so those are not sensitive to cap rate movements. Now, of course, they're sensitive to general macro and microeconomic factors. I mean, home building is a really, really interesting home building lot. So what we do is we develop lots and we sell them to merchant builders. So you've got home builders who are freaking out, right? Because you've got tariffs, you've got high interest rates, but there is a housing shortage that,
Yes.
I mean, you never say never, but there is a housing shortage that in most markets will never be really stabilized. And so as a result, if you can buy land at a good enough price and deliver it on time, home builders will buy it. Now, they'll pay maybe less now than they would have in 2022. But if you execute on that value add, maybe you make a little more money, maybe you make a little less money, but you're not going to be sitting on those lots unsold.
Right.
And that's why we like land right now.
Where are you doing your land investments in that strategy? I think that's an interesting one.
Yeah. And so we, obviously growth markets, but we do rely on sponsors to find that deal flow for us. So again, we don't chase markets in that respect, but I mentioned the one in Texas that's in Boerne, that's just outside of San Antonio, and we're working on one in Fresno right now. But that was just the result of just an incredibly low land basis. That was just a very opportunistic buy. And then the one in Boerne is interesting because at least on paper, all of the lots are under contract before we acquire the land. Now that's a unique situation. That doesn't always happen. But when a sponsor comes to you and says, hey, we're going to develop this land, but it's not on spec, right? All of the lots are sold to 3 builders. You pay attention, right? Because that's a huge risk mitigant. Yeah.
We've been active in that space. So we think highly of that strategy. We think there's just not enough housing in America. And you can sell lots today, even at elevated interest rates. When interest rates do drop down a bit, that'll just continue to grow. Okay, we're getting close to the end here, and Daniel, and I really want to kind of unpack the last part, which is really this understanding of how someone would spend time to kind of introduce themselves to you, and like, is it a first time meeting at a conference? Then it's like, look at a deal. The odds are that first deal probably doesn't make because it's like you're still underwriting them. What are like? How long does it take, and what's generally the process? And look, you're a busy person too. So how do you allocate your time to see these new opportunities and review, new relationships?
Yeah. And so there's a lot of questions in there. I mean, we have a great team. I spend a lot less of my time, almost none of my time doing the actual underwriting, which is obviously completely different from my career. I mean, that really is my job right now, is developing relationships with sponsors, with intermediaries like you, and then obviously raising capital. That's a new part of my job that I've just gotten into over the last 3-4 years, which I enjoy. It's a little bit different than real estate, but it is, for me, managing my time is going out and meeting new sponsors. That's not a burden on my time. That's my job. Yeah. So, just last week, I was doing an asset management trip. I was in Arkansas and then Oakland, right, on the same trip. I got a call from a great broker, and this is another good example, right? Yeah. A great broker, sort of a boutique broker, and he said, hey, I've got a deal, and we had been talking about it for a few weeks, but he's like, the sponsor is ready to go. Can you come down to California to, Southern California? Can you come down and meet him? And, I just booked a flight. I mean, I came home for a couple of days, booked a flight, and, it only took me, I was only out of town for, I don't know, less than 24 hours. It took me an hour to meet hour to meet the guy. We liked each other. We understood the business plan. But just like you said, that deal is not going to make. We dug into the actual deal, and there's a few things that we didn't love about it. But the point is I met him, and he's the kind of sponsor I like. He's been around the block a couple times. I talked to you about emerging managers and how that's difficult.
Yeah.
So it's just good old fashioned face to face. Just meeting with people, having dinner, having, maybe a drink, having a couple laughs. It's really a big part of it. I mean, underwriting those sponsors is really important.
I always make the joke that it's not a joke, but reality is an incredible deal can be messed up by a bad relationship.
Absolutely.
Nothing can be done to fix that. So, but you are really one of the great guys in this business, Daniel, and I'm really just thrilled that we were able to get you on here and be able to have you share the insights of your platform and your career. And Daniel, on behalf of myself and the rest of the Way team, we can't thank you enough. And have a great rest of your day. And thanks for spending time with us today.
Thanks, Malcolm. I really appreciate it.
Thanks, Daniel. Take care. Bye-bye.
All right, take care.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.